Okay, hi. So my name is Addy, and I'm going to take you through some of my introduction pieces that I've created. Can you see the screen?
Yes.
Okay, great. Let's do a slideshow here. So my name is Addy, and I have been trading this for the last 9 years. Like I said, almost 10 years. Um, the idea of these seminars is to show everyone how I've done it, and then see if it works for anyone. I'm a CFL level 3 candidate. I've passed the first two, just not getting enough time for the third one. And then I've been involved in the world of derivatives for a while, academically and then trading wise, for a good number of years. And I studied math and business at college. And the reason why, you should listen to me is because this is my year-to-date P&L. This is from my live trading account. You can just see the positions that I've taken. The bottom 4 or 5 are my stock positions, so I've just highlighted out of those. But this is my year-to-date P&L. I've made over $700, $800 by investing. I would say maybe, $1,600. I've made 700. So, and after commissions, I think these trades come out to be about 15 to 20% net profit. Um, And we've been the way we've been trading these markets, both sides of the market, short and long, it has been good to us this year. Don't get me wrong, when I first started, the first couple of years were tough. I was losing money. And then I kept practicing, kept changing things, kept changing my strategies. And that's how I figured that, this is the method that works. And I'll show you the exact method that we have. The idea for this webinar was to dive into just one specific strategy so that everyone can learn at least one thing that they can take action on. Previously, when we did this last month, we did a brief overview of a lot of different strategies, short option strategies, strangles, iron condors, credit spreads. But I think in order to take any action and be successful in this, um, everyone should just focus on one strategy first, nail that down, and then move on to the other one. That's how I've learned it. That's what's worked for me. And that's what I'm trying to show everyone. Next one, we'll go through some theory first of these options, and then I'll take you to the platform to show how exactly it works in practice, meaning we will put positions on. I'll show you exactly which buttons to click. That's the idea. Because that's how I learned it. I learned it on the platform by clicking buttons and putting positions on and taking them off and adjusting them. So as we all know, options can be a great way of making some passive income on the side. Um, when I say passive income, I don't mean go out and buy options because that's like a lottery ticket. We don't do that. It's a very low percentage of winning.
Dean, the
We
option trading's on.
Sorry, can you say that again, please? Okay. There's 6 things that we keep in mind when we trade, which are we trade small, we trade a certain percentage of our account on each position. We allocate a certain percentage of our account balance to each position. We don't go overboard. We don't take too much leverage because these products are already leveraged, and you just want to make sure that you are diversified enough for the portfolio to survive market downturns. So if there's a drawdown, if there's a black swan event, you just want to make sure that the market actually your portfolio can survive that. Anyway, we trade with higher probability of success, meaning we sell options, we sell out of the money options, and we select a duration which works well for these options positions, meaning we collect premium and we wait for the theta decay um, on these options. This third thing, the most important thing is to select or choose liquid underlyings, meaning you have to be able to choose um, tickers which have very narrow bid-ask spreads. Otherwise, it's really hard to get in and out of the position, and then we pay a lot of slippage. You call this phenomena slippage, which is if you trade illiquid underlying tickers, you will pay a lot of money to get in and get out of those positions. So first things first, we choose liquid underlyings, and I'll show you. I have a list of tickers that I follow. Duration, like I said, we go 40 to 50 days out, and we sell those options. We limit our downside by selecting spread strategies, meaning we do two-legged strategies, and then we define our risk. So these are all risk-defined strategies. So like I said, this is for if you are a beginner in this space, or even if you are slightly advanced in this space, um, the the best way to learn about these short options is to define your risk, because undefined risk trades can blow up your account very quickly. Defined risk is when we know exactly how much money we've put down and how to manage those trades. So the key piece here is like we initiate the trade, and if it goes against us, we manage it. With long options, you cannot do that. With long options, when you buy an option, you don't have this kind of option. The only option there is if you're losing in that trade, you can just only close it. Here, what you can do is you can move the spread out into time. You get more duration on your side. Volatility is our edge. We sell vol. So when we sell options, we are short vol, meaning when volatility goes up, we sell these options, and we try to capture some downside on the volatility piece, because volatility is a mean reverting asset, and I have some slides on that too. Um, Again, allocation should not be more than 50 to 60% of your account. Max allocation, I'm talking about. So if you have 10 trades, you should not go more than 50 to 60% of your account. So if you are trading with $100,000 account, you should keep 40 to 50,000 in dry powder. Because we manage these trades, there might be some more buying power requirements. There might be some margin requirements. So this is how we control the portfolio volatility. This is how we make sure that portfolio lasts longer, and we get more confident about these trades. Because if you start this thing and you start losing trades right away, you will be really discouraged, and you will lose out on this and then be like, oh, this doesn't work. I don't want to do this. Trust me, this thing works. I've been doing it for 8 years. First few years does not work. Fine, I get it, but it did not work for me, because I did not have somebody to hold my hand and explain all these things to me. So I went out and read all the materials and everything so that you don't have to do it. I'm explaining that the first 4 years can be completely eliminated from your journey. And we can go right into, first of all, what a long call and long put. Again, really, really simple stuff. We'll try and brush through this. You buy a long call, you pay a debit. So when you pay a debit, this part here, actually, I need to bring my pen here. Let me just get my pen out. Yeah, there you go. So when you buy a long option, this is the strike that you bought it at, and then this is the premium that you paid. So in order for you to make money on the long calls or long puts, first you have to cover this premium part, meaning the debit that you paid. So let's say you paid $5 of debit. The stock needs to go up $5 from here before you break even. This is the break even point. This is where you break even. Only after that, you make money. Same thing on the put side. When you buy a long put option, you're expecting the market to go down. But first, it has to move down by $5 for you to cover the debit that you paid. And only then you break even. And then after that, you make money in the green zone. Again, low probability trade. I will show you on the platform. It's no more than 50%, meaning there's only a 50% chance that this will happen, that the market will go down on you if you're buying a put option, meaning there's only a 50% chance that the market will be favorable to your side of the trade. Next one. Let's go to the next slide. Okay, this is the short option. I didn't clearly. Sorry, I need to remove these. Really new to the whole Zoom thing. Okay, cross this out. Short options. Again, let me bring my pen out. Actually, let's do a spotlight there. So on the short side, what you have is you have the probability on your side, meaning when you sell this option, the market has to beat you. You don't have to beat the market. When I say you don't have to beat the market, meaning you sold it here, this is the short call option, right? So your market, so you're bearish on this. When you sell a call, like when you buy a call, you expect the market to go up. When you sell the call, you expect the market to go down. So the market has to beat you. You don't have to beat the market because you have collected this money from the buyer of the option. When you collect this money, this comes in your account right away, and this provides you that positive cushion that you need if the market goes against you. And therefore, because of this premium collection, there is always the way we trade, we trade over 70-75% probability of success trades, meaning those trades have to have a chance of more than 70% to be a winner, both on the short put side and then short call side. Again, on the short put side, when you sell this option, and if the market goes against you, meaning the market is going down on you, when you sell a put, you are positive on the market, meaning you're saying that the market will go up. But when it goes down on you, you have this cushion, the $5 that you collected. Your break even will be further out by however much premium you collect. And that's why this provides you a more than 70% chance of winning in these trades. If I say delete, what does that do? Clear all drawings. Okay, that's what I want. Next slide. Oh, this is a very important one. Like, how do we select our allocation? Print this out. When I send these slides out, print this out, keep it on your computer. We do not go over 10% max on each position. This is by position and by account size. So, for example, you have a $5,000 account. Each position cannot be more than $500. Usually, when we put the trades on, we trade within $300 to $400 mark, 7 to 8%. That's our sweet spot. These are the max allocation that you should have. 10% max. 5% is a good number, but I don't think you can create a position or you can enter a position with lower than 350 to 400 in each trade. So you have to have some cushion around 500, 10% of your account. And what is implied volatility? These are the market conditions we look for. We look for high IV. There are two types of volatilities. One is historical, meaning whatever has happened in the past, you call that historical vol. But what will happen in the future is calculated by implied volatility in the options market, which means that, let's say 30 days out from now, the market is expecting a big bull run. So it will price the options accordingly. And based on that implied volatility, that gives us the edge to go short the market or long the market, sell those options and create and collect some premium. So for us as option sellers, IV is the most important thing we look at. We look at high IV symbols, liquid symbols, and then we sell those balls. And I'll show you exactly how we do it. Anyway, the reason why we do it is because if you go look at last 50, 60 years of S&P 500 data, or go back however you want, 70% of the time, or 68.5% of the time, to be exact, the price remains within one standard deviation of its mean. So if you're doing a mean of like monthly data, you have a monthly price data, and you calculate the mean of that price where has this price stayed on average. And if you go one standard deviation out from from that price on the upside and one standard deviation out from that price on the downside, that's where it is expected to stay almost 70% of the time. And that's why this normal distribution curves, it works. It's the industry standard. 95% of the time, that price is supposed to remain within 2 standard deviations of its mean. So within these boundaries here. And only, well, 99.7% of the time, this is based on math and stats, like how does the normal distribution works? This is how it works. Price remains within 1 standard deviation almost 70% of the time, and that's all we need to know. We don't go 2 standard deviation because then we don't collect enough. Then we don't collect enough credit or enough premium for it to be worth a good risk reward for us. Meaning we will be taking too much risk, but not enough reward in those positions. So we stay within 1 standard deviation. And the reason we think that these markets, especially volatility, I'll show you a vol chart on the live platform, and you will see how volatility is mean reverting. There is no other thing in the financial markets that are mean reverting, meaning price does not mean revert to its mean level. Price does not revert back to its mean level because it's always a moving target. Prices are either always going up or down. It's always a moving target. Whereas volatility is a mean reverting asset, meaning when it pops up, we know it will come down. And I'll show you what I mean on the platform quick. Okay, here, this is the list. These are the list of tickers we trade. Quickly, again, take a brief look at it. These are our favorite ones, futures options. The markets are in our futures options because that's where the best capital efficiency is. The futures market provides you with leverage. It provides you with, I don't think my video was on. The futures market provides you with leverage. It provides you with capital efficiency, meaning you don't have to put too much capital down to trade a credit spread or trade any kind of short, long option, whatever. And I'll show you that on the screen as well. Let me just go through these slides. Okay, correlation matrix. I created this for like our top symbols, just to show where and how to like how do we diversify our portfolio. So, for example, this is the highly correlated section in this matrix, meaning Qs, which is the Nasdaq index, SPY, which is the S&P 500, and IWM. You can see these are all very, very highly correlated. Well, IWM not that much, but you can see Qs and the SPYs are really highly correlated here. IWM as well, like if you go to the IWM column here, Qs and then the SPYs. Therefore, we select gold. Gold is not highly correlated with SPY or any other major indices. We select euros. We select, you name it. We select interest rates, which are bonds, and we select oil. These are all ETFs that I've taken, but these ETFs track their indices very, very closely. So there's not much tracking error. So you can just take these as proxies for the main indices. And you can see these are how the indices are highly correlated, but the other assets are not. So why am I showing you this? Because we take positions in non-correlated stuff or negatively correlated stuff so that we can diversify the portfolio. It's important to take these positions in different underlying markets, commodities, interest rates, bonds, whatever, so that your portfolio is diversified. If you are going to take 6 positions in the same index or 3 different indices, S&P, NASDAQ, and Russell, you are basically taking a position in just one index, which is S&P, because all 3 of those are highly correlated. So if the market goes up, those indices are going to go up together. If the market goes down, those indices are going to come down together. So therefore, that's why we try to diversify by taking positions in different markets, in low correlated markets where the premium is higher. And the premium is always higher with high vol. Anyway, let's dive into the spreads here. Short put spread. This is how it's set up. I could have done a better job on creating a better visual here, but um, time constraints. This is what I got to finally. We sell a spread. This is a short put spread. Again, I showed you a short put before, which was um, undefined risk, meaning you're selling a naked option. Here you are defined risk, meaning you know your max profit is $2 or max loss is 2 and your max profit is 3. These lines will define your caps on the upside and on the downside. This will give you peace of mind. That's how we start. We start with a spread strategy, either on the short put side or the short call side. And then we move on to a iron condor when we adjust these, meaning if this thing goes bad on us, what we will do is we will sell a call side here and make this an iron condor like this. We will sell a call spread to be bearish on the market. And then this whole thing will, now you can see by looking at these lines that this is a iron condor with defined risk. That's how we manage the trades. Again, it'll be better to like see it on the platform. But this is how we initiate. If we are going long a market, and we are contrarian traders, so if the market goes down, I would like to sell this into the strength of the market where the premiums are juicier. Meaning, if the S&P 500 goes down, I would sell puts as a risk reversal trade, not sell calls, because the premiums are always juicier on the where the market goes. So if it goes down, you will collect more premium on the put side. If the market goes up, you will collect more premium on the call side. Again, take it with a grain of salt. Selling calls have not been a really profitable one for me for the last, I don't know, maybe 2-3 years because the market has been so bullish. We think 70% of the time the market goes up. You call this a positive drift in the market, meaning a lot of the people, 70 to 75% of the people are looking to buy assets in the market, and therefore they are willing to bid up the prices. So selling calls in indices, especially the major indices, has not been a great way to do this, whereas selling puts has been the best one because the market has been so bullish. But we sell calls in commodities and we sell calls in interest rates and other markets. Let's go to the next one here. Short call, same thing. You are bearish on the market. You are defined risk on both sides. I just want to show you how we manage this trade if it goes against us. It's really important to know how will you manage it if it goes. Taking a position is fine. You can do it in 3 seconds. It's about what happens when it goes against you. Do you know what you can do? Do you have an option there? Yes, we do. We manage this trade. We close out the risk and we sit on these trades, collect data, and then we move these out into different expiration cycles and give ourselves more duration to be correct. Again, like I said, in these strategies, you don't have to beat the market. The market is trying to beat you. When you buy options, you have to beat the market because the market has to go up on you. Here, the market can either go up, down, whatever, and stay with it. As long as it stays within a range, you will make money. And again, how to manage this? We will sell a put side and make this into an iron condor. I see there is a. Let me just finish this. When we go to the platform, I will take questions from the chat. Okay, next one. Again, I had to put this on again because it's an important slide. It's an important one for me. Therefore, everyone should know how much money to invest in each position. Really important. Do not overload yourself with $800, $1,200 in each position. The way we trade, we don't put in more than 500 anyway, but that's one contract. If you trade more than one, then you will end up allocating a lot more capital, which we don't like to do. Diversification is key. We don't throw good capital after bad. And I'll show you exactly what that means on the platform. Again, I have some Greeks here, so take a look at this. Long calls are always positive deltas. It increases with stock price. Gamma increases with delta. It's a second derivative of delta. So if delta goes up, the gamma will move with it, and it moves quicker in the last 15 to 20 days of the trade. And therefore, we try to get out of that trade or move out of that current expiration cycle and into the next one to give ourselves duration to avoid any gamma risk. You must have heard this term, gamma risk, in the market. That it's a real term, meaning for short sellers, especially, the gamma moves really quick and fast in your portfolio. It can take away your profits, and therefore we try to stay away from it. Theta, again, it's negative for long calls and long puts, but it's positive for short positions, and therefore we take short positions. Our main strategy is short vol, long theta. We collect time by sitting on it, and we collect time when the volatility drops. Again, I have some real world examples here. Take a look at it when I send the slides out. Let me know if you have any questions on this. Vega is for volatility. Like I said, it's positive for when you buy options. It's negative when you sell options. This is just to help you understand these Greeks. These are the main 5 ones we look at. Liquidity is again, we look at a couple of things. We look at the bid-ask spreads, and then we look at open interest and volume. And I'll show you that on the platform in a minute. What else? Trade execution. How do we execute these trades? Yes, fine. We know how to set it up and everything. How do we press the button and send it so that it executes? So we do not take market orders. Market orders are basically for people who are trying to get in right now, right away. We try to bring the market to us. We sit and wait unless we really want, there's a saying in the market that whether you want to take or you want the price. We sometimes take the price that's given to us. We sometimes, wait for the tick, meaning we put our own price in, and we see if we do get that price in. So we use limit orders mostly. 90% of our orders are limit orders. We select the price. Again, take a look at this. Some background on what these orders are. These are the 2 main ones we use. We don't use stop losses or stop limit orders or whatever junk that is out there. Stop losses are the worst things that you can do to your portfolio, meaning if you put a stop loss in and it hits and it executes, meaning you've taken a loss on that position right away. Yes, you have saved yourself from further losses, but then you've also taken away the possibility of making money when the trade comes back to you. So we don't put stop losses. We manage the trades actively. We are active traders in these markets, so we follow our positions, we monitor our positions, but we don't put any stop losses in there. Again, when you get into this, the first few weeks, practice on your trading account, your paper trading account, and get the feel of the market. Stay calm in volatile markets. We love volatility, meaning when the market is panicking, we go out and sell it. And I'll show you the trade examples that I've done it recently. August 5th, if you would remember, it was a big volatility spike when the markets went down more than 100 points. And I looked at it as an opportunity, sold some put spreads, and then made some nice profit on it. Real trade examples, we'll go to the, let's go some housekeeping here. Just follow these links if you want to. I post videos on my YouTube channel, and then I discuss these trades on the Discord channel as well with my community. Everything is free, obviously. There's no charges right now. Just trying to build some faith and just trying to get my name out there to see if people like this kind of strategy and the way I've been trading it. Let me take you to the platform. Okay, there's some chats. How do you correct? Sorry, how do you correct if the market is against you? Trades up for options or futures. Options on futures just to begin with. Options on futures to begin with. This is going out to Johnson. I will show you options on futures on S&P 500. And then the first one was, how do you correct if the market goes against you? So the way you correct is you adjust the trade by selling the other side of it. And let me show you the exact setup on the platform. Let me take everyone to the platform here and share my screen again. Okay, here. So this is my paper trading account. So just make sure you practice in your paper trading account before you go live. You've got to have at least 25 to 30 trades under your belt before you go live. This is a strangle position I took yesterday. It has come in nicely here. But again, for practicing purposes, strangle is like an undefined risk. I think I was trying to create a video of it, and then I did this trade and then basically left it there, forgot to close it out. Okay, we are in the ES options market, which is up 33 points this morning. First things first, we go to the chart section, look at volatility. I was actually trying to show you vol. So let's go to VIX. You must have heard of the VIX index. VIX is the 30-day out implied volatility of the S&P 500 market. So you can, if you have to draw a line, you can clearly draw a line here at 13, 14 level. And that's what the average level is for VIX, or has been in the last however many years. You can just go here. I have a 1-year chart. You can go back and like change this to let's do a 5-year chart, and let me show you like how this volatility works. Let's do a 3-year chart, right? Look, same thing. It goes up, it comes down. Volatility goes up and volatility comes down. It peaks and then it goes down. That's what you call a mean reverting asset, that it comes down to its mean level. August 5th, it went up to like 60. When volatility goes up, the premium is really juicier. We sell premium. And look, the next day, it came down. When you are short this thing, because as an option seller, you are short volatility, you are shorting this spike. And the next day, next few days, it all came back. Let me change my chart to 1 day because I like that 1 day thing just to like take a look at the markets. I normally keep it at 1 year, 1 day, meaning one whole year, and it's a daily price level. That's what I like to look at. So let's take this off. No, I need to delete it. I was showing you a setup in the ES market. So open up the series. First of all, click here. This is my watch list. I have some futures positions here first. Then I have all the stock positions, which I don't normally trade because they are not very capital efficient. I do trade them, but not that as often. But futures markets is my go-to market because you'll see the difference in the capital efficiency that we get for the same amount of credit and money that you can make in the other markets. Now let me show you this. For example, we are 42 days out. This is my go-to expiration cycle anyway. I already have a position here, which I can close whenever. 42 days out. Where has the market been? Market has been on the upside quite a bit. You see this? In a normal circumstance, we will sell the upside. But again, like I said, indices, you have to be really careful on the upside. Because look how it goes all the way to the top right. Hockey stick kind of chart. So we are very careful selling the upside. But if I was to trade this, which I wouldn't trade it right now, I wouldn't take a live position on a index right now. But I'm just showing you this because it's the most popular index. I'm showing you this as an example. Look at the bid-ask spread here, only off by like 25 cents. This is what we like seeing. This is the tightest or the closest it will ever get. So we go to our 17 delta mark. That's our sweet spot. We short the strike on 17 deltas. which is giving us 60/30 right now, 6,030 points on the index. You right click here, right click, and then you sell a vertical. Now this thing comes up again. Make sure your number of contracts are down to one. At least I start with one, but just make sure you don't take too much risk in one underlying asset. You have to diversify that risk. If you have more capital to invest, you would rather do it in other markets, not just one market here. Okay, so I'm collecting $2. When you sell on ES futures, on S&P 500 futures, this is the actual amount of money that you collect is half of this. It's half of this number. So you're seeing $2 here, which means you will collect $100 overall in this trade. That's a little bit on the low side because the market has been up. Like I said, when the market goes down, that's when you get more premium. But when the market is up and the volatility is down, you don't get enough premium out of these positions. So we stay away from the indices when the markets are up. We go into other markets like the rates. Bonds are down quite a bit. This would be a better example to show, but again, it'll be a slightly different product to get your head around. I want people to like understand the indices first, and then and then my next sessions will be around these other products. But let's just stick to ES, which is one of the one of the more popular ones, the most popular one right now. 42 days out. Again, I had a short call, which is here. Okay, bring it here. So on the top right, sorry, is someone making anything? What happened there? I need to take that option away. 1 second. Okay, what platform can you use as a beginner? I would say Schwab, which is TD Ameritrade. So this one is called TD Ameritrade. This is the best one I have. I have traded on. And yeah, the best one is out there. Webull, I'm not really sure about Webull. I don't know what their platform is like. I've never traded there. But if I were to start right now as a beginner, I would start on Schwab, which is the TOS platform, Thinkorswim, they call it. And I think I need to. Thinkorswim, yes, that's the one. Yeah, you call it TOS. That's the one. Get its desktop platform. Best thing out there so far. Sean, can you mute yourself, please? Or maybe I can. Yeah, got it. Okay, let's get back to the platform. I was showing you the trade setup. Let's get back in there. Okay, so where is our trade setup? Okay, these are some of the numbers you need to be careful on and make notes of. Whenever you set this thing up, always make sure the probability of profit, for me at least, I like the number 7 in front of everything. So it has to be more than 70%, meaning there's a 70% chance that you will win in this trade. And the underlying asset will stay within this point, which is right now, and these points here. Now, if you were to sell this on the put side, I can bet that you will get more than 80% chance. And we can check that out right now. Let me bring out the put side as well, like a short put spread. This is really annoying. I have to clear the goings out before I can do anything else. Okay. ES on the put side. Again, 17 deltas is the sweet spot. So let's go down there. We start at 17, and I'll show you how to how to adjust this trade by converting this into an iron condor later. So we're selling, right click, sell a vertical. These are the buttons you have to click. So I'm trying to prepare you to at least open up your trading account, like a paper trading account at Schwab or whatever. Start practicing here. Because no matter how much I tell you, no matter how much theory I give you, unless you go out and trade this yourself, that's the best way to learn. That's how I learned it. So look at this. You're getting $2.25. And if I take this into the Analyze tab, take away the my call spread was not $20 wide. So I have to have it $20 wide on both sides. So let's close out the call. Let's take out the call side here. Now let's look at the put side. See, if you were to change this set slices, go break even, 11/16, you have to match your date here with your break even slices here. This setup will give you the exact probability of profit, and that's what we try to look at. Now, don't get me wrong, this is a one standard deviation move. So if you look at some of the numbers here on top, this is the range of one standard deviation. Now, if you scroll here, you can select two standard deviation as well, meaning this stock is expected to move within this range between now and expiration with a two standard deviation move, which only happens 93% of the time, whatever the percentage was in our slides. But to be very, very realistic, we stay within one standard deviation and look, it's showing that we have an over 80% chance of winning. Now, the reason for that is put side is always more juicier than the call side for the exact distance. So the reason I say that is because people are more fearful in the market, so they go out and buy put options. All these big hedge funds, big institutions, big endowments, they go out and buy put options. And because of that, there's people are bidding up the price of the put side. And when you sell that juicier option, you collect more premium and your probability of profit increases. This is something that you call skew. Meaning if I have to go from at the money from wherever the market is trading right now, go down 50 points, equidistant on both sides, the amount of money that I will collect on the put side by selling it and on the call side will be different. Put side will be higher than the call side. In most cases, in most situations, or I will have a higher probability of success on the put side, because again the put market is juicier and it has more skew. So look at this number. You have an 88% chance of winning on the put side. Anyway, because we were trading the call side, let's just put that trade in. And then again, did I mention that the ES trades, the futures options in S&P 500, we always do a $20 wide spread. So we are shorting it at 6030. We are buying the option at 6050. One contract. Let's confirm and send and put this in. This screen is also important to look at. Buying power effect. Now you should know exactly how much money you're putting down, what are your commissions, and how much are you expected to make in this trade. Now, you are collecting $187.50. That's your net collection right now, but you are paying $4.50 to get in. Because there are two legs, long and short, I think the charges on my account are $225 for each leg. I have tried to negotiate this down. They're not having it. Maybe on the other platforms you can get it cheaper. I don't know. But because of the functionality of this thing, I don't mind paying a slightly higher commission and stay within this platform. Anyway, $4.50 to get in. Now also remember, you will pay $4.50 to get out, because when you close this option, you have to pay the two legs again. So right now you are short the call spread. You'll have to buy back that call spread. Anyway, the important thing is you're only putting down $289 to make a potential 183. But the way we trade, we don't wait until 100% premium is collected. We close our positions at 45 to 50 to 60% max profit. Meaning when the spread is when the P&L on the spread would be around $100 or 90 to 100, I will try to close this trade out and redeploy the capital somewhere else. Because at that point, my profit target has been hit. Because think about it, if I'm making 50% annual and I annualize that number, if I'm making 30%, 40%, and if I do this thing continuously for the rest of the year, annualized number will be a lot higher. Meaning I collect one from here, 40%. Then I go out and then I do this in the next cycle again. Then I collect another 40%. So when you annualize this or you do it 12 times a year, your P&L will be a lot bigger. So let's put this trade in, cancel this out, confirm and send. Send this. We'll just take the market here. I mean, I don't want to wait. Usually I would put my own price in, so I will lock this up. I will put this up a little bit. So if I was doing this in my live account, I would put the price up a little bit. And the price of the ES options trade in 25-cent increments. So from 375, you can only enter $4 here if you want to sell above the market. But right now, for training purposes, I'm just going to take the market at 375. Let's see if it gets filled. Right click, send. And that's how and that's it. It got filled. So on the top left, you can see that these two bars come up. This means that your trade has been filled. Now let me just close the strangle that I had from yesterday, so we can just focus on the call spread. Where's my strangle gone? I think I messed up this trade. Strangles. Okay, this is my strangle at 6,000, and I cannot find it. Where's my other strike? Is it the same strike? Maybe I took it on the same strike. Actually, just leave it there. I think it's more confusing. Anyway, now, how do you manage this trade? Yes, you have got the position in. This is how the position looks. Great. You will sit and wait on it. Let me just show you the Greeks. Select -10 plus 10. Look at the Greeks. You are slightly short delta because you sold a call spread, right? So you are short the market. Now, the reason we are short the market is not because I've done a lot of research on this product and I think S&P 500 is going to go down from here because it's trading at a higher multiple and price to earning fundamentals and all that. I don't look at fundamentals. It's basically just price driven and volume driven and all that. The reason I've sold a short call here is because the market has run up on us too much, too quick. So as a risk reversal or a contrarian trader, I would like the market to either stay sideways or come down. That's the rationale, nothing else. Don't complicate this to any more than it needs to be. Short call, that's it. We know how to manage it. So I'm going to sleep well over this. Even if the market goes up on me, I know exactly what I will do and when. Question is, when will you adjust? Now you've collected $187, right? Whenever your P&L is -100 here, meaning you've collected it 187 or 200, let's say, and you are already -100 P&L, $100, I mean, that's when I will come in and I will sell the calls and the put side and convert this into an iron condor. At that point, the put side will be trading slightly different from what it is right now. But just to show you how to adjust, I will sell this, right click on the put side. At that point, I will not be selling at 17 deltas. I will actually be selling at maybe 25, 30 deltas. So let's select that. Because if the market goes up, right, if the market goes up, then the call deltas are going to be around 25, 30. That's when I will look to adjust. And therefore, I will need to close down those deltas, meaning I will have some deltas on the call side, and I need to close those down by selling something on the put side, and I will try and select the same number of deltas so that then I'm market neutral. So at that point, I'll probably be selling at 25 deltas. So this is the one that I will sell at that point, not right now. When the market goes against us, do we feel, and at that point, if you feel like, the market has some way to come back and do whatever. Anyway, at that point, I will sell this. I will sell this spread, collect another $300. So when you collect more money, you sell more, your break evens widen out. So even on the call side, your break even is going to widen out. we don't let these trades to create a too big of a loss for us. We manage this early, but not too early. There's a certain mechanic that you have to follow. Um, and that mechanic is basically you look at the deltas, see how big those deltas are, how much risk is in this position, and therefore you sell the other side. Now you're market neutral. Now you sit on it. If you still have days left in this spread, we move the whole spread out into time. So we will go to the next duration cycle, next expiration cycle. We will take another 45 days and sit on those strikes one more time. And this system has been working for us for the last few years. Especially I showed you the P&L this year. I haven't been able to like trade a lot of, make a lot of trades because of my day job. It's a busy thing. I don't really get the time to like analyze the market and figure out which positions to sell. But whenever I've done it, I think I'm only down on the rates, the ZB position a little bit. Every other position has been a winner for me. So this is how you manage it. I showed you the Greeks. I showed you both sides of it. Let me take the questions here. I think there is one here. Oh, 15 each side? That's a lot of money. I don't think that's I don't think that's true. But oh, maybe you are buying the outright future. Check if you are trading a future or an option on future. Because options on futures are cheaper. For Canada, I'm not sure. But I don't pay 15. I just showed you, right? I pay for each leg, I pay $4, sorry, $2.25. And they're not negotiating that. So that's the amount of money I pay. If you are paying 15, then it's not worth trading on toss. Find a cheaper broker. Yeah, they refuse to do anything for me as well. I mean, I've been trading on it for a while, but whenever I try to negotiate, they just don't have, they don't want to talk about it. So it's a bit of a setback with toss. Not a really customer friendly team there, but because they have the best system, I'm still living with it. But as soon as I find a newer one and I get my head around that platform, I will be switching right away. That's the idea. Anyway, if that was the presentation, I hope you liked it, and let me know if you have any questions. Email me. I think I showed you everything. Let me just share it one more time. How to contact me. These are my contact details. I will send the presentation out as soon as I'm done here. But yeah, contact me here. YouTube, watch our channel. I think I posted a video on it yesterday. Go look at these videos. You'll definitely find something useful there. There's some that people have liked more than the others, and there's some that people have, you know, like this S&P 500 one. People have liked that NASDAQ one. So check these out. Email me. Join the Discord channel if you can. I will send the slides out right away. Um, I'm thinking about coaching and teaching, but nothing has been set up yet. Like you mean one-on-one coaching and teaching, right? Or even groups, yeah. I mean, that's the idea. I'm trying to set things up. It's really hard to like find time to like set things up and create these groups and emails, so email people. But I don't buy options. Um, the next question was, do you buy leaps? No, I don't buy options. If I were to buy an option, I would buy a spread, not an outright option. And again, when you buy an option, remember, if you are really, into buying options, only ever buy at the money options. Just think about it. The further out of the money you go, less probability, less chance you have of winning that trade. So always buy at the money options. But again, if those are expensive things to do. You can make, if not same amount of money, but close to similar with selling options and doing that trade again and again, again and again. That is true. Futures are a bigger product. If you are more comfortable with stock, I think my previous presentation, I just took Apple stock and I went with it. So most of my YouTube videos are on, with stock setups. So go look at that. I mean, I like stock positions too. Futures is just that it gives me more leverage, uh, but it gives me more bang for the buck. I know futures are bigger. They all have different standardization, different contract specs, and different everything. So that's why I try to stick to the popular ones, which are S&P 500, NASDAQ, Russell, and then ZB, which are the bonds, oil. By the way, if you were to trade in oil, if you want to trade oil, I would trade in the futures options market instead of ETF or any other market. Gold as well. Gold is also and FX. How else can you trade FX? You just go out and buy the spot. Those spot pairs do not have options. CME Euro futures, those guys have options on them, so you can sell them. That's called a cash secured put. So, like I said, like I showed, right? We don't sell naked options. So what you are mentioning to me here is you're selling puts naked, and in order to be safe, you have to hold some dollars in your account because you will be put the stock. When you sell puts, you will be put that stock, meaning you will end up buying that stock. So you have to hold some US dollars. When you sell the calls, the stock positions get called away from you. So when you hold a stock, you sell the call side. When you don't have the stock, you have to sell the put. If you're selling a put side, you have to hold US dollars. So, like I said, the way we trade, we don't trade naked options right now. I like strangles. It's one of the best strategies out there. I know it's risky and it's people are scared of it, but because we trade risk defined stuff, we don't worry about getting assigned or holding anything in our account because think about it. If our short strike is tested and it's in the money, we get put the stock, but then our long side is also in the money. So as soon as we get put the stock, we give away that stock right away. Right. So net. Uh, the next session, I'm not sure. I have to set it up. I have to set it up maybe within the next 2 weeks. I did one a month ago. My next one could be in 2 or 3 weeks. Keep an eye on the Eventbrite event page. That's where I will post it, and we will just take it on from there. What would you like to learn in that session? Like what? What would be your best thing to learn? Just give me an idea. I will send an email to this group, basic of futures. Okay, I can cover that. Yeah. Right after this meeting, when I send the slides, I will email this group with the slides. So take a look at the slides and keep in touch on the email. That's all I can say. It was good connecting with everyone. Thank you everyone for joining. I know a lot of people have left, which is fine. Hopefully we can get a bigger, more engaging group next time and we can go through some more stuff. Thank you very much, everyone. I can buy, sell adjustments. I need help. Okay, no worries. Yeah, John said we will go through all of that. Not a problem at all. Keep an eye on these on my Eventbrite page and my own website as well. I post my trading cohort link on my own website. I don't know if I showed you guys. Let me just quickly show you the website that I maintain for these trading cohorts as well. So actually that thing is not up and running right now. Anyway, yeah, Eventbrite. That's the best place. I will post my next one and I will email everyone. Okay, thank you everyone. Thank you everyone for joining. See you next time. Great. See you later. Bye.